Welcome to the deep dive. Today we're plunging into the ever-evolving world of global tax compliance. And this isn't just minor tweaks anymore. We're really witnessing a fundamental shift, a global sprint towards full digitization. It's completely redefining how tax authorities and, well, businesses interact. We're talking about a move towards truly transparent, hyper-efficient, and really effective tax systems globally. And right at the forefront of this digital wave, making some pretty significant changes, is Malaysia. They're embarking on a new era with their mandatory e-invoicing system.
That's right. And our mission for this deep dive really is to give you a true shortcut to understanding Malaysia's new mandate. We're going to unpack the why behind it, the crucial when it all goes live, and maybe most importantly, the practical how for businesses like yours. Our goal is just to make sure you walk away feeling well-informed, without getting totally overwhelmed by all the details.
Yeah, exactly. We've distilled insights, guidelines directly from leading experts in digital tax reporting and, of course, official government updates. So, okay, let's unpack this and get you truly well informed. So let's start with the big picture then. Why? Why is Malaysia implementing such a significant change to its tax system now? What's really driving this?
Well, it's interesting because what Malaysia is doing, it isn't happening in a vacuum, right? It's actually part of a much broader global trend. We're seeing these e-reporting mandates and what we call continuous transaction controls, or CTCs, popping up everywhere. Many countries are moving this way for, very similar reasons. The core goals for Malaysia seem pretty clear. They want to significantly enhance tax compliance overall. They want to drastically reduce tax fraud, which is a big issue everywhere, and ultimately improve the overall efficiency, kind of streamline processes for both businesses and the government itself. See, e-reporting, or real-time reporting as it's often called, it fundamentally changes the game. It lets tax authorities, like Malaysia's Inland Revenue Board, the IRBM, evaluate indirect tax info almost as it happens. Just, imagine the IRBM getting a digital snapshot of every single sale and purchase you make moments after it occurs. That's really the power of these CTCs.
Wow. Okay.
And this helps them track economic performance, trends with incredible precision, and crucially spot inconsistencies, errors, even potential fraud much, much earlier than traditional methods ever could. What's, I think, really fascinating here is how Malaysia is adopting a post-transaction CTC model within its e-invoicing mandate.
Post-transaction, how does that differ?
Right. So unlike some countries where you might need pre-clearance before you can even issue the invoice, Malaysia's approach lets you issue it first. Then it gets validated in real time by the IRBM system. This probably offers businesses a bit more operational flexibility day to day, while still giving the IRBM that immediate high-resolution visibility they're looking for.
Okay, that clarity on the why and the specific CTC model, that's really helpful. Now, for businesses actually operating in Malaysia, the when is absolutely critical. So when does this all kick off? And maybe more importantly, who feels the impact first?
Yeah, absolutely right. The timeline is crucial for planning. So the mandatory e-invoicing system officially starts on August 1st, 2024. That's the key date.
August 1st, 2024. Got it.
But it's not like a switch is flipped and everyone's on it at once. Malaysia is taking a, I think, very sensible phased approach. They're scaling it up based on a business's annual turnover. So phase one, that kicks off August 1st, 2024, and it impacts the largest businesses, those with annual turnover exceeding MYR 100 million.
The big players first. Makes sense.
Exactly. Then phase two begins in January 2025. That brings in businesses with turnover between MYR 25 million and MYR 100 million. And finally, phase three. That covers basically all other taxpayers, and it comes into effect in July 2025.
That phased rollout sounds logical for, a smoother transition, but I've also heard quite a bit about a grace period. How exactly should businesses be thinking about using that time? Is it just a delay or something more strategic?
That's such a critical question. And no, it's definitely not a pause button. It's really a strategic ramp-up period.
Yeah.
So yes, a grace period has been granted until February 2025. Now, during this time, businesses are actually permitted to generate what they call consolidated e-invoices for all their transactions. You can sort of bundle them up. This temporary measure, it gives companies that extra time to adjust their internal systems, their processes, before the full enforcement of individual e-invoicing requirements kicks in after February 2025.
So how best to use it then?
Well, the best way to use this grace period is really to treat it as a robust testing phase. Don't wait until, January 2025. Use this time now to perfect your internal workflows, test your systems thoroughly, train your teams, get everything ironed out.
That's a really powerful distinction. Not a delay, but a testing phase.
Yeah.
Okay. So what does this actually mean for you if you're operating in Malaysia? Beyond the dates, what are the practical sort of day-to-day steps businesses need to take to comply?
Right. There are several essential requirements you absolutely need to nail down. First, invoices have to be electronically generated and submitted to the IRBM for validation. No more paper shuffling for this. You've got two main ways to do this. You can manually upload them through the MyEnvoy portal, which is probably useful for lower volumes or maybe as a backup. Or for higher volumes, you can set up an automated system using an API, sending data in XML or JSON format.
An API, like a direct connection.
Exactly. Think of it like a direct digital pipeline between your accounting system and the IRBM's system. It allows, thousands of invoices to flow seamlessly without anyone manually uploading anything. And the IRBM has even released a software development kit, an SDK. It's like a pre-built toolkit for IT folks, making it much quicker for them to set up that connection.
Okay, that's helpful. What's next?
Second, digital certificates. These are mandatory for all businesses issuing e-invoices.
Yeah.
You have to get these from a licensed certificate authority, a CA, and they're linked directly to your tax identification number, your TIN. Their purpose is absolutely crucial. They verify who's sending the invoice, ensure the invoice hasn't been tampered with its integrity, and you need them for the digital signing before you submit. Now, the procedure to get them is apparently user-friendly, but still, don't delay. It's a foundational piece of this whole puzzle.
Got it. Certificates. What else?
Third, the invoice structure itself. This is a big one. A valid e-invoice needs to include up to 55 data fields.
55. Wow, that sounds incredibly detailed.
It is, and you need to be precise. For instance, consistently capturing something like the buyer's email for notification across all your sales channels might seem minor, right? But it's crucial for the IRBM system to actually send those confirmations directly to your customer. And after it's successfully validated, the e-invoice will contain an embedded QR code. That QR code basically serves as the official seal of approval from the IRBM, proving it's validated and legit.
Okay.
Which really means businesses need to focus hard on data readiness and, crucially, data cleansing before they even think about submitting. Garbage in, garbage out, right?
Absolutely. 55 fields. Okay, what's number 4?
Fourth, you'll need to issue self-billed e-invoices for certain types of transactions.
Self-billed, so I invoice myself.
Kind of. Normally, your supplier sends you an invoice. But with self-billed e-invoices, your business actually generates the invoice for specific types of purchases. This typically happens when you're buying from, say, an overseas supplier who isn't registered for Malaysian tax, or maybe from a local individual who isn't running a formal business. It just ensures these transactions, which are still relevant for your tax calculations, get properly documented and reported to the IRBM from your side.
Okay. That sounds like it could impact accounts payable quite a bit.
Oh, definitely. It necessitates new controls and processes in your AP department to manage these correctly.
Right. Okay, what's 5th?
Fifth is about international standards. Malaysia is adopting PEPL, PIN. That stands for Malaysia PEPL International Invoice. It's all about cross-border interoperability.
PEPL PINT sounds complex. What does it actually do?
Its goal is actually quite simple, despite the name. Think of it like a universal digital language for e-invoices. It means a Malaysian business using PEPL can send an e-invoice to, say, a partner in Europe, and their systems will automatically understand each other. Makes international trade potentially much smoother, fewer errors. So, PEPL's PINT rules cover e-invoices, credit notes, negative invoices, all conforming to specific Malaysian PEPL specs.
Interoperability. Okay, makes sense. Anything else?
And finally, number 6, archiving requirements. All e-invoices must be archived for 7 years. This aligns with the existing Income Tax Act 1967, so it's a pretty standard retention period. It's also important to know that all validated e-invoices will also be automatically stored in the IRBM database anyway.
7 years. Okay, that's a comprehensive breakdown of the requirements. Quite a lot for businesses to manage. To make it even clearer, maybe let's walk through the actual journey of an e-invoice, step by step once a business generates it. How does it flow?
Sure. So the workflow kicks off when the supplier issues the e-invoice. Again, either manually through the MyEnvoy portal or automatically via that API integration. Step 2, the IRBM performs real-time validation. Checks against all those standards, the 55 fields, the digital certificate, everything.
Instantly.
Pretty much, yeah, real-time. Upon successful validation, step 3, the supplier gets a unique identifier number back from the IRBM. That's the stamp saying it's officially cleared. Then step 4, the validated e-invoice, now including that visual representation with the QR code for easy verification, is shared with the buyer. Step 5, notifications go out. Both the supplier and the buyer get confirmation of the clearance. Or importantly, if the buyer needs to reject it, that notification goes out too.
Okay, rejection. How does that work?
There's a crucial 72-hour window for handling rejections or cancellations. Think of it like a short grace period after validation where you can still essentially hit the undo button if there was a mistake or the buyer has a valid reason to reject it.
But only 72 hours.
Exactly. Don't wait too long. Finally, step 6. The validated e-invoice is permanently stored in the IRBM database. And if we just connect this back to the bigger picture we talked about, this whole real-time validation and notification system, it drastically increases transparency for the tax authorities, gives them almost instant insight into economic activity.
Yeah, that 72-hour window seems tight but crucial. Very clear journey. Now, a common point of confusion, I think, for businesses is how this system handles sales directly to consumers.
Yeah.
B2C transactions. Is it the same process?
No. B2C sales actually have a different, slightly more flexible approach, which makes sense given the volumes. For business to consumer or B2C sales, suppliers have the option to consolidate these supplies into a single e-invoice. They can do this if they choose not to issue individual e-invoices for every single tiny transaction. Imagine a supermarket trying to do that.
Right. Yeah, that would be impossible.
So they can consolidate. This consolidated invoice must then be submitted to the Malaysian tax authorities within 7 calendar days after the month ends. So you gather all your B2C sales data for, say, July, and you have until the 7th of August to submit one consolidated e-invoice covering all of them.
7 days after a month end.
Okay, and a key clarification here. Upon validation of this consolidated B2C invoice, the IRBM notifies only the supplier.
Only the supplier. Why is that?
Well, because these invoices are essentially issued to the general public, right? There won't be individual rejection requests coming back from thousands of consumers. It simplifies that part. It's also worth noting, this consolidation option generally doesn't apply for those self-billed e-invoices we talked about earlier, with maybe a couple of very specific exceptions like acquisitions from individuals not running a business or interest payments to the public. But mostly, consolidation is for regular B2C sales.
Okay, that B2C clarification is really useful. Consolidation makes practical sense there. So, given all these detailed requirements, the processes, the timelines, let's talk consequences. What happens if businesses don't get this right?
Yeah.
What are the penalties for non-compliance? You mentioned a stick earlier.
Yeah, the stick side, it's pretty serious. The penalties are indeed severe, and Malaysia is clearly signaling they mean business with this rollout. Businesses could face fines. These range from a minimum of RM200 up to a maximum of RM20,000, and that's per instance of noncompliance.
Per instance, so every incorrect invoice could be a separate fine.
That seems to be the implication, yes, per instance. And it doesn't stop at fines. There's also the very real possibility of imprisonment for up to 6 months, or potentially both a fine and imprisonment.
Wow, okay, that's serious.
It is, and these penalties can apply to various forms of noncompliance. Failure to issue an e-invoice when you're supposed to. Issuing an incorrect or incomplete one, maybe missing some of those 55 fields. Or late submission, beyond the deadlines we discussed. It really just underscores why businesses absolutely need to use that grace period wisely, like we talked about. Avoid complacency. Avoid these potentially significant penalties. It's not just about getting it done, it's about getting it done correctly and on time, every time.
That's definitely a powerful incentive for compliance, and it truly emphasizes the importance of thorough preparation. So as we start to wrap up this deep dive, what are the immediate actionable insights you think listeners should take away? If you're a business in Malaysia listening right now, what should be your absolute top priorities?
Okay, key takeaways. First, and I honestly can't stress this enough, prioritize preparation. Now, even with the phased rollout in that grace period until February 25, IT and operational teams should not delay getting ready. The sheer volume of work involved, system integration, data cleansing, procrastination is going to be really costly here.
Don't wait. Got it. What else?
Second, strategically plan your transmission methods. Decide now whether that manual MyEnvoy portal works for you, or if you need the automated API submission. Maybe it's a mix. You might consider using manual just as a temporary workaround, but only while you're actively implementing a robust automation solution for the long term.
Plan the how. Okay.
Third, implement robust processes. This isn't just about sending data, it's about managing a whole new workflow. Think about exception handling, what happens when an invoice gets rejected. Reconciliation matching IRBM data to your books. And put in tight controls, especially for those complex self-billed e-invoices. Get the process right.
Processes and controls. Makes sense.
Fourth, Related to what we said earlier. Ensure impeccable data quality. Focus relentlessly on capturing all those required 55 data fields accurately, consistently. Perform data cleansing before submission. Clean data is key to avoiding rejections and penalties down the line.
Data quality, crucial. And
Finally, and this is critical, engage all relevant stakeholders. This is not just an IT project or a tax department issue. You absolutely must involve departments like finance, operations, sales, procurement. Everyone needs to be on board. Their input, their cooperation, it's essential for a smooth, compliant transition across the entire organization. Get everyone talking.
great summary. Prioritize prep, plan transmission, build processes, ensure data quality, and engage everyone. Malaysia's bold move towards e-invoicing, it really does signify a new, pretty dynamic era in global tax compliance, doesn't it? And it feels like businesses that not only embrace this digital shift, but actually navigate it confidently. They'll be incredibly well positioned for a much more efficient and compliant future.
Absolutely. And maybe a final thought to leave you with. This transformation, it isn't just about invoices, It's really about a fundamental redefinition of real-time financial transparency for both governments and businesses. So what might this mean for other jurisdictions? Could this push them towards similar models even faster? Or even how might businesses themselves start managing their internal financial processes differently beyond just tax compliance if this level of real-time transparency just becomes, well, the norm?
That's a truly fascinating thought to chew on. A fundamental redefinition of transparency. Definitely something for you to reflect on. How might your own business or organization need to adapt to similar digital shifts in the future? Perhaps in ways that go far beyond what we traditionally think of as just tax compliance.